Good morning, everyone. My name is Eric Sims. I'm a professor and the department chair in Notre Dame's Department of Economics. Whether you are joining us in person or via live stream, we are delighted to have you here with us. We are in for a real treat today as we get to listen to an economic outlook speech from Federal Reserve Governor Christopher J. Waller. In addition to being one of the most insightful and impactful central bankers of our time, Governor Waller is also a dear friend and former colleague of ours here at Notre Dame. A member of the Board of Governors since 2020, Governor Waller has been at the forefront of the Fed's efforts to tame inflation, promote full employment, and macroeconomic stability in the wake of the COVID-19 pandemic. Prior to his appointment to the board, Governor Waller was Executive Vice President and Director of Research at the Federal Reserve Bank of St. Louis, the Gilbert F. Schaefer Professor of Economics here at Notre Dame, and a faculty member at both Indiana University and the University of Kentucky prior to that. Governor Waller will be speaking on the economic outlook for several minutes. Afterwards, I will moderate a brief discussion, including time for questions from the audience. There are microphones set up at the right and left of the stage at the front. I'll let folks know when it's time to line up for questions. With that out of the way, let's all give a warm Notre Dame welcome to Governor Christopher Waller.
Excuse me while I get set up here a second. All right, good morning. Good morning. I gotta wake up my class. As Eric said, I came to Notre Dame about 20 years ago to help rebuild the economics department, and then after a number of years I left and went into public service, working at the Federal Reserve. So it's always a pleasure to come back and see the campus and engage with the faculty all once again. So all I gotta say is go Irish. So I wanna thank the department for giving me the opportunity to speak today. My topic is the outlook for the U.S. economy and the implications for monetary policy, a set of judgments that have, of course, been influenced by this morning's jobs report. When I scheduled this speech several months ago, I knew it might be challenging to speak a few hours after the release of such an important piece of data. But we like to say that monetary policy must be nimble, so that means policymakers must be nimble also. Not Simone Biles nimble, but nimble. As you will hear, I believe the data we've received this week reinforces the view that there has been continued moderation in the labor market. In light of the considerable and ongoing progress towards the Federal Open Market Committee's 2% inflation goal, I believe that the balance of risk has shifted toward the employment side of our dual mandate and that monetary policy needs to adjust accordingly. Looking back at the economic data over the first 6 months of 2024, it portrayed an economy slowly cooling and not showing signs of significant weakening. The labor market had been gradually moderating for the past year or so, and although inflation rose in the first quarter, it then retreated in the second, and there was a widespread view heading into the second half of the year that the FOMC was on track to achieve a much desired but unusual soft landing. When the July jobs report came in unexpectedly soft, job creation had slowed and the unemployment rate increased by 0.2 of a percentage point to 4.3%, the highest since October of 2021. There was speculation that weather-related issues might have distorted these results, and in fact, the unemployment rate ticked down in this morning's release. But overall, the August report, along with other recent data that we got this week, tend to confirm that there has been a continued moderation in the labor market. The ups and downs in the data over time highlight what I consider the right approach to meeting the FOMC's dual mandate goals. I believe we should be data dependent, but not overreact to any data point, including the latest data. When we faced a period of banking instability in the spring of 2023, there were calls from some to stop rate hikes, despite inflation running over 5%. But there were other tools in hand to deal with that stress. Monetary policy did not overreact, and the FOMC continued tightening policy. When inflation fell unexpectedly in the second half of last year, we did not overreact and immediately cut the policy rate. And then when inflation accelerated in the first quarter of this year, we did not overreact and raise rates despite some calls for us to do so. I will be looking at the last two employment reports in combination with all other data we have received as we head into the September FOMC meeting to decide the best stance of policy. I believe our patience over the last 18 months has served us well. But the current batch of data no longer requires patience. It requires action. Today's jobs report continues the longer-term pattern of a softening labor market that is consistent with moderate growth in economic activity, the details of which I will get into in a moment. As I said at the outset, considering the progress we have made on getting inflation back to target, I believe that the balance of risk is now weighted more toward the downside risk to the FOMC's maximum employment mandate. While the labor market has clearly cooled, based on the evidence I see, I do not believe the economy is in a recession or necessarily headed for one. The collective set of economic data indicates to me that the labor market and the economy are performing in a solid manner, and the prospects for continued growth and job creation are good. With inflation near 2%, I continue to believe that this can occur without substantial harm to the labor market, but I also believe that maintaining the economy's forward momentum means that, as Chair Powell said recently, the time has come to begin reducing the target range for the federal funds rate. In the rest of my remarks, I will lay out my reasons for believing that the economy and employment will likely keep growing as inflation moves towards 2%. The first of these is the large body of evidence that economic activity is continuing to grow at a solid pace. Real gross domestic product grew at a 2.2% annual rate in the first half of this year, and recent data indicates that growth is continuing at around that pace in the current quarter. Retail sales were stronger than expected in July and showed that households continue to spend as their finances in the aggregate remain healthy. The increase has been fairly broad-based across goods categories. While many online retailers offered discounts last month, this was not a dominant factor in the solid results. Although manufacturing output fell in July, and the August Institute for Supply Management Manufacturing survey pointed to weak production and weak new orders, the similar survey for the larger non-manufacturing sector was consistent with modest expansion. As for the labor market, on balance, the data we have received in the past 3 days indicates to me that the labor market is continuing to soften but not deteriorate. And this judgment is important for our upcoming decision on monetary policy. As I said earlier, Wednesday's report on job openings in July was consistent with a moderating labor market. Meanwhile, the 4-week moving average of initial claims for unemployment insurance has risen gradually since January, but has changed little on net over the last 2 months, with initial claims remaining fairly low. The jobs report for August, which was released this morning, supported the story of ongoing moderation in the labor market. After rising to 4.3% in July, the unemployment rate ticked down to 4.2% in August. Taking a longer perspective, the unemployment rate over the past 16 months has increased gradually but fairly steadily from 3.4% to 4.2% in today's release. Payrolls rose by 142,000 in August compared with 89,000 in July, leaving the 3-month average payroll gain at 116,000 per month. But you have to compare that to 267,000 on average in the first quarter and 147,000 in the second quarter. Now, accounting for some revisions to job numbers that we received in August, that level is a bit below what I see as the break-even pace for job creation that absorbs new entrants to the workforce and keeps the unemployment rate constant. July marked the first time that the 3-month average unemployment rate has increased by at least half a percentage point above its 12-month low, which was 3.6% in July of 23. This breached a threshold established by the SOM rule, which observes that when this has occurred in the past, it has been a reliable indicator of the economy entering a recession. While this correlation that certainly bears attention, I want to make a few cautionary points about relying on such rules in deciding when a recession has begun. As we have seen in the recent past with other supposedly reliable recession rules, such as an inverted yield curve, there is more to forecasting economic outcomes than the relationship between a couple of variables. First, these rules are nothing more than a mechanical, statistical description of past economic outcomes. They do not seek to explain what economic forces drive the relationship between the data, nor are they based on the totality of economic data. All recession rules do is pick up a correlation between movements in economic data and the dates of recession or other outcomes. A second point is that setting aside the unusual circumstances of the 1981-82 recession, recessions occur when a major shock hits the economy. In the absence of a big negative shock, an inversion of the yield curve or a triggering of the SOM rule doesn't mean we are entering a recession. Third, these recession rules typically pick up demand-driven recessions. But this is not why unemployment is rising now. GDP forecasts for the current quarter all show solid growth. Labor market data show layoff rates are stable, and consumer spending is growing at a healthy rate. These data suggest demand is fairly strong. Instead, most of the increase in the unemployment rate is from workers entering the labor force and not finding jobs right away. So the recent rise in the unemployment rate appears to be more of a supply-driven phenomenon, not a demand-driven phenomenon. And lastly, it should be clear to everyone that many pre-pandemic economic relationships have not proven to be good policy guides post-pandemic. Reliance on old lessons from inverted yield curves to predict a recession, a Phillips curve to predict inflation, or a flat beverage curve to predict the movement in the unemployment rate have all led to mistaken economic forecasts. Now, while I don't see the recent data pointing to recession, I do see some downside risk to employment that I will be watching closely. But at this point, I believe there is substantial evidence that the economy retains the strength and momentum to keep growing, supported by an appropriate loosening of monetary policy. Let me now turn to the outlook for inflation. With the labor market cooling, it doesn't surprise me that wage growth has slowed to a pace that I see as being consistent with the FOMC's price stability goal, and this is supporting ongoing progress toward that objective. The employment cost index grew at an annualized rate of 3.5% from March to June, and the 12-month change was 3.9% for private sector workers, the lowest since late 2021. Now, I think, I should speak for myself, we typically think if you have 2% inflation and productivity growth of 1.5, wage growth should be about 3.5%. So we're not that far off with numbers but around 3.9. Average hourly earnings reported in today's jobs report rose at a 3-month annualized pace of 3.8% in August. So again, not far off 3.5. Now, inflation in July continued to show progress toward the FOMC's goal. The price index for personal consumption expenditures, or what we call PCE inflation, increased at a monthly pace of 0.2% in July for both total and core PCE inflation. Core PCE inflation, which excludes volatile food and energy prices, is a good guide to the underlying inflation, and it increased 2.7% over the past 12 months. Remember, our target is 2. Given the downward trajectory of monthly readings, I also look at the 6-month and 3-month annualized rate, and these stand at 2.6 and 1.7% respectively. So these numbers are good news and suggest that our restrictive policy stance has put us on the right path to attain our 2% inflation target. Looking across the components of inflation, one can see the breadth of the disinflation that has been occurring. Over 50% of categories in the total and core market baskets had annualized monthly inflation less than 2.5% in August. In fact, the index of core goods prices has reverted to its historical pattern of slight deflation, reflecting normalized supply after the disruptions of the pandemic, as well as ongoing technological and productivity advances. Meanwhile, services price inflation has slowed as wage growth has slowed, since labor is a large input for much of the service sector. So overall, I see significant and ongoing progress towards the FOMC's inflation goal that I expect will continue over the remainder of the year. Now we get to the drum roll. Let me discuss the implications of this outlook for monetary policy. Most of the media and financial markets skip my whole speech and go right to the last 2 pages. As I said at the outset, considering the achieved and continuing progress on inflation and moderation in the labor market, I believe the time has come to lower the target range for the federal funds rate at our upcoming meeting. Reducing the policy rate now is consistent, for example, with many versions of what are called the Taylor rule, which suggests reducing the policy rate is appropriate given the data in hand. Furthermore, I do not expect this first cut to be the last. With inflation and employment near our longer-run goals and the labor market moderating, it is likely that a series of reductions will be appropriate. I believe there is sufficient room to cut the policy rate and still remain somewhat restrictive to ensure inflation continues towards our 2% target. Now, determining the appropriate pace at which to reduce policy restrictiveness will be challenging. Choosing a slower pace of rate cuts gives time to gradually assess whether the neutral policy rate has in fact risen, which a lot of people have been discussing. But we do so at the risk of moving too slowly and putting the labor market at risk. Cutting the policy rate at a faster pace means a greater likelihood of achieving a soft landing, but at the risk of overshooting on rate cuts if the neutral rate has in fact risen above its pre-pandemic level. This would cause an undesired loosening of monetary policy. Determining the pace of rate cuts and ultimately the total reduction in the policy rate are decisions that lie in the future. They are not going to be decided today. But as of today, I believe it is important to start the rate cutting process at our next meeting. If subsequent data show a significant deterioration, not softening, but deterioration in the labor market, the FOMC can act quickly and forcefully to adjust monetary policy. I am open-minded about the size and pace of cuts, which will be based on what the data tell us about the evolution of the economy, and not on any preconceived notion of how and when the committee should act. If the data supports cuts at consecutive meetings, then I believe it will be appropriate to do so. If the data suggests the need for larger cuts, then I will support that as well. I was a big advocate of front-loading rate hikes when inflation accelerated in 2022, and I'll be an advocate of front-loading rate cuts if that is appropriate now. Those decisions will be determined by new data and how it adds to the totality of the data and shapes my understanding of economic conditions. While I expect that these cuts will be done carefully as the economy and employment continue to grow in the context of stable inflation, I will stand ready to act promptly to support the economy as needed. Thank you very much for listening.
Okay. Thanks so much, Governor Waller. And like I said, we'll have time for questions from the audience in a second. So I'll let folks know when it's time to come up. I have a couple of questions myself. And you addressed some of this during your talk, Governor Waller, but you frequently, including today.
Call me Chris. You've known me for a long time, man.
I have known Chris for a long time. You frequently speak about data policy being data dependent. Right. And you touched on some of this, but I'd like to unpack it a little bit. As we know, data are noisy, data are potentially subject to large revisions. We had a data release this morning, and you mentioned how you don't want to overreact to that. But at the same time, policy needs to be very forward-looking, right? It's well understood, I think, that monetary policy affects the economy with a considerable lag. And so being data-dependent, being forward-looking, there's a certain tension there. And so how do you sort of work with that tension in your day-to-day, and what are some maybe forward-looking variables that you pay particular attention to when thinking about the appropriate course of policy?
Right, so this is a standard kind of issue with looking at data and setting policy on the data. If you're going to look forward in the data, which sounds intellectually great, and that sounds smart, and that's how you should do things, the thing is we don't have the data from the future. So what you are then doing is making forecasts about what you think is going to happen in the future. And if those forecasts are wrong, then the course of policy that you're choosing based on those forecasts may have serious ramifications. And let me give you just a couple of examples. When you're looking forward and using certain economic models for doing things. In 2021, I and a lot of my colleagues thought the inflation we were seeing was going to be transitory. All the economic models, all of the stuff we looked at said, look through this data, it's all temporary, and inflation is going to come back down by the end of the year. It did not. And we set policy based on that forecast. So there's an example where looking through the current data, looking forward, led you to potentially make a mistake and not moving faster in terms of your policy. When we started raising rates, as I mentioned in my speech, there was a lot of discussion about what are called Phillips curves, which is the trade-off between inflation and unemployment. Those were viewed as very flat, meaning to get inflation down, you had to have a big increase in unemployment. Something called the Beveridge curve, which shows job vacancies to unemployment. Historically, relatively flat, meaning to lower vacancies, you had to have a big increase in the unemployment rate. Turns out, both of those relationships tended to be wrong. They did not give us good guidance on policy. So that's exactly the tension, that we have to kind of think about policy, but we have to use we have an idea, we all have. Look at our SCP, Survey of Economic Projections. That's kind of our forecast for where we see the economy going and how we set policy. But that forecast could just turn out to be wrong. And that's where you have to be nimble and adjust policy as the actual data comes in and start adjusting your forecast.
Great. Kind of as a follow-up to that, and maybe you addressed some of this. You've been a policymaker for a long time now, but you've been at the board during a very interesting time in U.S. macroeconomic history since December of 2020. With the benefit of hindsight, do you think that the Fed could have done things differently in 21, 22, and how that would have impacted where we are today? What might you have done differently?
Yeah, I mean, I gave a couple speeches on this 2 years ago, so I'm not saying anything I haven't already said. But I think, one, the guidance we gave in December of 2020 that we would keep the rate at zero and continuing, we keep the rate at zero until we achieved our dual mandate, meaning you're at 2% inflation and employment. But then if you think the normal policy rate is 2.5%, you got to go from 0 to 2.5%. And that is like, why are you doing that instantly instead of some sort of gradual hike? So I think that was a little too restrictive in terms of tying our hands to the zero lower bound. We should have had probably a little more flexibility or escape clauses in that. I also think that our asset purchase program traditionally, when we had this in the past, we weren't going to do anything with rates till we ended asset purchases. And in the past, we did that at a very slow pace. And we gave guidance kind of along those lines. And we ended up having to have a very rapid stoppage of our asset purchases. And then instead of waiting for any period of time, we immediately started raising rates as soon as we ended. So we probably should have had some better guidance about when we would stop asset purchases. And probably, I argued back in 21 publicly that we probably should have stopped buying MBS. The housing market was on fire. We didn't need to be supporting mortgages and interest rates at that time. So we probably, I was arguing then we should have probably stopped that earlier.
And a follow-up to that as well, if you think back to December 2020 when you joined the board and you have the benefit of hindsight today, what do you think has surprised you the most about the behavior and the evolution of the U.S. economy over those 4 years, both maybe on the upside and on the downside?
Yeah, I mean, the way I kind of look at the pandemic is, man, you just shattered the economy. You threw a shock that we had never seen and blew up all the existing kind of economic relationships that we were used to using to think about things. We didn't think inflation was going to explode. We didn't think we were going to see, raising the policy rate 500 basis points and unemployment wouldn't move. I mean, these were things that were just not normal. There were reasons we could think through those things, but that was the hard part, is like realizing that all your past economic relationships were failing in a certain way. And that you had to be very nimble, look at the data, really adjust on the fly, with the hope that as things normalize, these relationships would come back together and provide a more useful guide for policy. So, the pandemic, I just always think the pandemic was an extremely special circumstance that has never looked like any other recession we've had in U.S. history. And it just threw a bunch of stuff in our face that we're probably not going to face again.
Hopefully not.
Hopefully not.
Hopefully not. And then, maybe related to that, as I said in the introduction, you've been both an academic at the research frontier, going to conferences, publishing papers on new topics. You've also been at the forefront of the policymaking world, at the front lines of trying to stabilize the U.S. economy in the face of this big shock. How would you say that your time as an academic working on the research frontier has informed who you are today as a policymaker? And if you were to go back to academics, and we would love to have you back, Chris, how would your time as a policymaker influence the kind of questions and research that you would do back in academia?
Yeah, so there's always this issue, like when you're an academic, you're doing your research and you're trying to make it relevant to people, that somehow it matters. And it does. So I'll give a very specific example, which anybody listening outside the room has heard before, but there was a huge debate in 2021 where some of us were arguing we had to start tightening policy faster because inflation was taking off. And a lot of people said, if you do that based on these Phillips curve, flat Phillips curves, these flat Beveridge curve relationships, you're going to cause employment to explode. You're just going to kill the labor market. And I was looking at the labor market going, there are 2 jobs open for every person looking. It seems to me if you raise rates, you could push down labor demand and it would show up through a reduction in vacancies, not unemployment. People wouldn't be laying off workers. And when I went around, and this is the important part about policy versus academics, when I was going out and talking to the business community and I would ask them, are you going to lay off your workers if we raise rates? They're like, are you kidding? You know how hard it was for me to hire these people? The last thing I'm going to do is lay them off. So I had that kind of anecdotal information, which is, again, this is the difference between policy. You have to rely on this anecdotal info. And so I was just making the argument that we could raise rates, bring down labor demand, put downward pressure on prices and wages through a reduction in vacancies, not through unemployment. I was publicly ridiculed for taking this stand. Nevertheless, I had some good basic economic theory about Beveridge curves that I used to say, look, the Beveridge curve is this curve that looks like this. And right now we're not on the flat part, we're on this part, the steep part, which means you could bring down the vacancy rate and the unemployment rate doesn't change. That's exactly what has happened. So there was a case where I used a straightforward economic model that I'm sure the faculty here teach their labor graduate students to say, look, I plotted out the curve and I said, I'm going to tell you the data points are going to land on that curve, and they did. So that's where economic theory helped me a lot. On the other side, going back, once you're in the policy world, you tend to think of things in a much more shorter term horizon, like certainly monetary policy. We talk about the long term, but you tend to be much more, I shouldn't say firefighting, that's the wrong word, but you're always worried about the near term. Where in our economic models, for example, in macro, you're looking long term. It's always about longer term cycles and long term growth. And that's kind of the big difference. There's a much more immediate focus on policy because you're held accountable for it. I mean, that's really what it is. So it tends to be the issue of, if I came back to academia, it would be more like always thinking, what are the big issues that matter? And the models are a good guidance, but how do you use like this anecdotal evidence to shape how you would do policy? There's an art to central banking. There's an art form. We have to take data, we have to look at models, we have to use that together to make an informed judgment. And that would be something I would do if I went back to teaching.
Okay. One more kind of on-the-fly follow-up question for me, but I would encourage members of the audience, if you want to ask Governor Waller questions about monetary policy, his experiences, where things are going, please don't be shy. We've got microphones here on the front right and front left, so please feel free to line up. Chris, I sometimes worry as an academic that policy is kind of oftentimes fighting the last war, if you will. And for a lot of time through the 2010s, monetary and fiscal policy across the developed world was heavily influenced by what had happened during the financial crisis and Great Recession. And the last 3 or 4 years, we've been fighting the post-COVID recession, which, as you noted, was a very unusual economic shock, one that we hopefully won't get again. How do you use the past, the near past, to inform policy today, but not rely on it too much, understanding that the next shock is likely to not be just like the COVID-19 shock that we just had?
Yeah, I mean, that's the thing, is usually when you're in the policy world, you have to rely on the past as a guide. I mean,
Yep.
it just is. But the past doesn't always repeat. So, for example, I would say that when the pandemic hit, and we were expecting a huge recession, and we look back at the financial crisis, it took a long time to get the economy out of this hole from the great financial crisis. And so all of the policy tools we adopted were kind of designed for that playbook that we thought was going to carry forward with the pandemic. But in this case, the economy recovered actually relatively fast. And that was, like I would say, go back to our asset purchases of these things, our forward guidance, which was more thinking the previous thing and wasn't really adapting quite to what was happening. So, I mean, I think that's the tricky part, is you have to kind of look at the current situation, what can I learn from the past, but how is it different now, and how do I have to adjust my policy stance? Great. And that's back to the art of doing central banking, not the science of central banking.
Great. So it looks like we've got some folks in the audience. So over here on the left, I'd like you to state your name and ask your question to Governor Waller.
Governor Andres LaRosa here. First of all, thank you for being here with us today. My question to you is, how much do you believe excessive government spending has contributed to the rise in inflation that we've seen over these past few years?
You know, we take a view in the Fed that we don't comment on fiscal policy. They just take it. Congress does what they want to do, and it's my job to react to it. I don't evaluate whether it's right, wrong, or optimal. And that's good. I don't comment on fiscal. They kind of stay away from me. It's a good relationship.
All right.
Thank you. I appreciate it.
Thanks. Over here, one more question. One of our PhD students.
Hi, Chris. Thank you so much for being with us today and for speaking. My question is pertaining to inflation and maybe the elements of it that aren't included in like core PCE measurements. So given the unprecedented levels of food inflation that we've experienced in the past few years, do you think that it poses any sort of threat to the Fed's goal of price stability? And is there anything monetary policy can do to help on that front? Or is it just kind of hitting Americans in their pockets and the Fed isn't really able to kind of help contribute to easing that?
Well, overall, our target is all in inflation, which includes food and energy. So we often say we look at core and we dismiss it, not because we don't think it's important or it's not our job. Those things are so volatile, they don't give us a good prediction of where inflation is going, back to Eric's point about current data versus looking forward. So we've long tossed energy and food out. It doesn't mean we don't think they're important. It's just looking forward, they don't give good forecasts. If you can bring, on average, all inflation down across all goods categories, you'll bring inflation down. Now, one of the things there's been a lot of discussion on, and I just make this point, us getting inflation back to, say, 2% does not mean prices are going to go back to 2020 or 2019. They've gone up. We had this slope that's very high inflation, and now it's flattening out. But it's flattening out at a very high price level. So to get prices down, you would have to have very, very restrictive monetary policy in a way I don't think anybody would want to see what happens from that. So in a sense, if wages catch up, the price level's high, eventually your real purchasing power will be back to where it was. And, I don't dismiss any of the pain and suffering people have from this. I know I go to the grocery store myself. I'll look at certain products and say, hell no, I am not buying that. I can afford it, but I'm not going to pay that for that. So, we all do that too. So it's really this idea that food prices are just higher than they were and they're probably not coming back down. A lot is because labor costs have gone up dramatically and firms have to recover those labor costs. Wages are not going to go back down either to 2020, and so you just have to take that into account.
Thank you.
Thank you. Over here on the right.
Governor Waller, thank you so much for being here. My name is Sebastian Piers. I'm a senior. My question is, we've seen recently former President Trump making it known that he believes that the president should play a larger role in setting economic policy, or at least influencing it. What are the internal conversations within the Fed been assessing that risk and understanding how to go about adjusting that?
Well, I'm just going to kind of repeat what Chair Powell has said, which is independence has served us well for roughly a long decades. There's tremendous support from this in the Congress. And there's tremendous support from it from the financial markets. The financial markets do not want to see a politically driven Federal Reserve in terms of their policies. So financial markets, Congress, they all understand the value of it, and they do it. Now, if the president wants to complain about it, he's free to do so, just like everybody else. Doesn't mean I have to listen or adjust policy for that. But he's entitled to every damned opinion he wants, like anybody else.
Great. Over here on the left.
Welcome, Chris. Tony Huddy, Notre Dame grad from '84, long time. My question has to do with global. I'm particularly very concerned about Eastern Europe, the Middle East, and specifically China. So how does the Federal Reserve react to these global changes, which can happen overnight based upon some dictator's decision? How do you bring in the global impact to our economy?
Right, so I'll just sort of try to frame it this way. Our mandate is to say we want stable prices, maximum employment, and solid growth. So anything that affects those three things, that's what I'm going to respond to. So there's lots of events people would say, oh, this is going to cause this. It doesn't cause it in the end. It doesn't change. So if I were trying to react to it before I see any evidence that it affects the macroeconomy, I'd be way off on policy. That doesn't mean that these things aren't those kind of macro shocks I talked about that can throw you into a recession. There was a lot of concern when Russia invaded Ukraine that this could lead to a massive global shock and create a recession in the US. Fortunately for us, it didn't. And if I had responded that way, it would have been a bad policy response. So we have to wait until we see whether these external events show up in inflation, output growth, and employment. And if they don't show up there, I don't respond to them.
Thank you.
Great. Over here on the left, Chief Span.
Oh, thank you, Governor, for being here. My name is Ray Weber. I'm a freshman here. My question just has to, I know it's already been touched on, but my question has to do with the relationship between data and public sentiment. I know data has a massive impact on forming economic policy, but based on recent opinion polls and the overall public sentiment of Americans, many Americans are dissatisfied with the current economy. Yet, the mainstream media, coming from the White House, they have used data to demonstrate that the economy is actually functioning quite well. So my question is what do you believe to be the better test of the economy and its functions? Specific data coming from outside resources or public opinion?
Right, so that's a very good question. So, like I said, we typically look at the aggregate macro data. That's our best guide. That's how we measure our success or failure in hitting our dual mandate. People's perceptions, consumer confidence, for example, we always look at consumer confidence across a variety of measures because that affects people's decisions to spend, save, a variety of things. And so these things do matter also for their inflation expectations, which is critical to monetary policy in terms of how we do things. But at the same time, I want to go back to just the food example. There's a difference between inflation and the level of prices. People are angry about the level of food prices, and I just said, I get it. But inflation, the rate at which those prices are going up, has come back down closer to our historical norms, which is my job. Like I said, my job is not to get prices back to where they were in 2019. That is not the mandate I have. So you can have this kind of disconnect between levels of prices and growth rates of prices, and there's nothing wrong with it. It's just there's a distinction between what I look at and the consumer looks at. And there's another interesting, there's some research by a woman economist at Harvard whose name has just completely slipped my mind. Stancheva?
Stephanie,
Yeah, Stephanie Stancheva. It's this kind of funny thing. Like, to an economist, if you say prices went up 10%, your wages went up 10%, you're no worse off in real terms. But in her work, talking to people and consumer, the wage increase is 100% justified. The price increase is 100% unjustified. They earned the real wage increase. They didn't deserve the. So it's this kind of misperception, the way economists would look at it is, you're in real terms no worse off. But people have perceptions about wage increases versus prices that affects their attitude towards things.
Thank you.
great example. Over here on the right.
Governor, thank you so much for speaking to us. You mentioned that whether the labor market is deteriorating versus softening is going to be a big thing that the Fed is going to look at over the next couple of weeks. So my question is, what pieces of data do you think are expected to come out that will influence whether you think it's deteriorating versus softening?
Well, there's a whole set, we got a whole set of labor data this week that showed, some softening, but not deteriorating. And today's jobs report showed jobs were a little lower than forecast. But like I try to point out to people that our long-run measure of job growth that would be kind of equilibrium with labor force growth is between 80 and 100,000 a month. So even if you make some adjustments and job growth is down to 100, that's fine. That's nothing to be afraid of. But we've had such high labor market job growth for the last couple of years that anything close to 100 now sounds bad. But if you take a longer, this is back to long run, short run, you take a longer run view, that's what we think is normal in the long run. So again, it's kind of adjusting our current experience to what we think about is important for the long run.
Great. Over here on the left, another of our
Steve
PhD
Schoen,
students.
PhD student. There's been a lot of recent media reporting about the rise of what are called ghost jobs, because as the marginal...
I missed the...
Sorry, there's been a lot of media reporting recently about the rise of what are called ghost jobs.
I still didn't catch what kind of jobs?
Ghost jobs.
Ghost jobs.
A ghost job, as the marginal cost of posting a job has gone down, companies have started posting jobs for non-employment reasons, either to signal to investors or to basically try to cultivate data about the applicant pool. As the ghost jobs proliferate, is this muddying the quality of job vacancies as a economic signal?
Right, so I've been hearing this argument since I made my beverage curve prediction in 2022. If that argument was true, unemployment would be exploding. With all the tightening, I said this is through true declines in labor demand. If it was all fake, then real labor demand would be causing unemployment to go up. So I think there is some seriousness to these are not fake or ghost job postings. Furthermore, if they're ghosts and they don't cost anything, why would you ever take them down? Why should vacancies even be falling in the first place? Second of all, you look at private sector measures of job postings like Indeed. The JOLTS and Indeed, they move pretty close together. And these are not free. These are not free on Indeed in terms of posting. You have to pay for this stuff. It's not like you're gonna leave it up there. Now, does that mean that vacancies don't have multiple purposes compared to the past? Absolutely they do. But I think the fundamentals of it are still the same.
Thank you.
Great, thanks. Over here on the right.
Hi, Governor. Thank you for being with us today. My name's Sebastian Whitaker. I'm a senior in the econ department. Really enjoyed everything that they've done for us in my time here. But my question to you is regarding something that Kevin Warsh recently said. And he's said that we've been attributing inflation to wage inflation, but to him it's becoming increasingly apparent that it's government spending that's been driving a large aspect of inflation. I was kind of interested in I'm not asking you to comment on what you think about fiscal policy, because like you said, you don't comment on that. But I am interested to know if the Fed shares his view of this, and or what your opinion on his take is.
Yeah, so there's been this debate, President Goolsbee and I have talked about this. From a macroeconomic point of view, the view is always wages adjust to inflation, not the other way around. Wages don't go up out of the blue for no reason, and then inflation has to follow it. So it's usually there's some inflation, wages catch up, and so wages don't cause inflation. What was different about this time is kind of my little narrative on the pandemic. When the pandemic hit, we had kind of a semi-controlled shutdown of the economy. The big shock was the labor force contracted. People dropped out of the labor force, massive early retirements. People didn't want to go back and risk being infected or potentially dying. But all the essential stuff, you're sitting at home ordering your stuff from Amazon, somebody's got to be producing it. You want your food delivered, somebody's got to be producing it. Somebody's got to do that work, and you're asking them at that time to take a big risk to do that. Well, guess what you have to do to get them to take that risk? They got to be paid a lot more. Now, the goods demand, all that was getting very high prices to cover those wage costs, but the service sector, for the most part, was shut down. When they reopened, that was the wages they were now facing. They had no choice but to pay those wages when they opened, and they could only do one thing, and that was pass it through in the form of the prices that they charged. So that was, again, one of these pandemic relationships that certainly on service side, the big driver of wages, which was the earlier goods market, other essential products, drove up wages. Service sectors had no choice but to match it, and then they had to pass it through. So there's a case where wages, in my view, in the service sector did drive a lot of the inflation we saw. But it's not that workers were evil or trying to, that's just the wage. It was just what you had to pay. But firms had to pass that through.
Thank you.
Great. Here on the left.
Hi, Governor. My name is Elle Marble. So I know you mentioned a lot of curves when you look at data and plotting on curves. And I know that you said that they could be unreliable at times. So what curve, in your opinion, has helped most when forecasting the economy and creating policy? And has that changed from when you were appointed and to now?
Yeah, I mean, the thing is, I was just pointing, I don't want to beat a dead horse, but, this debate about could you reduce labor demand and it would only show up in vacancies or would it show up in unemployment? I use a straightforward chapter 1, graduate labor 101 kind of labor model about the beverage curve. And I made this argument back in May of 22 that based on where we were in my estimate of this beverage curve, we could bring down vacancies through lowering labor demand through tighter policy, and unemployment wouldn't go up. It was kind of a bold prediction at the time, and like I said, I was highly ridiculed by a lot of people for even claiming that that was possible. But it's worked. The data has literally almost fallen, not quite, but almost right along that curve. But the thing is, that curve, we've come down the steep part, now we're getting to the flat part. And so I'm sticking to my same model by saying, look, if we keep going, then the next thing that's gonna happen is employment will fall, unemployment will take off. And so that's why we're at this kind of kink point. We gotta be very careful now about how much restrictiveness we put on monetary and the policy in the future. But this model for me has been great for the last couple of years and has done well in helping me think about policy and what we can achieve.
Thank you.
Great. We're here on the right.
Hello, Governor. I'm Andrew Fidosa, a new AP with the department. Thank you for your talk today. So, in your position as the governor, you have a tremendous amount of power, but also the burden of responsibility that your actions shape how people view the Fed. As someone mentioned this morning, it's a repeated game as well. What actions you take will change how we view the Fed in days to come. My question is, are there any actions you would like to take that are within your power that you chose not to take because you're worried about how they'll change people's perceptions in the coming years or potentially for your successor going forward?
Yeah, I'd have to say right off the top of my head, I can't think of something. I mean, my job involves a lot more than just setting interest rates. So, for example, I head the committee that oversees all the reserve banks, all the spending of the reserve banks, all the searches for the presidents of the reserve banks. I also head the payments committee, so I oversee the U.S. payment system, which is a big global player in payments. I was in India last week giving a talk on payments. There are lots of policy things that have to be done in those spaces as well that nobody ever listens to unless you're in those industries. And sometimes there are things I wish I could do in those spaces that maybe I just have to wait because they require a lot of cooperation from other agencies or internationally. So I'd like to do it, but I can't unilaterally kind of force something on somebody. So that's where the cooperativeness on other parts, banking regulation, all this, requires cooperation across agencies. And things I'd like to do, I just can't unilaterally do.
Thank you.
Great. Here on the left.
Yeah, hi, Governor. Thank you for being here. I have a question. You said Fed should be data dependent, and we should not rely on predictions too much because prediction might go wrong. But from the model I learned, I feel like consumers' expectation also plays an important role in macroeconomics, and I feel like consumers' expectation is somewhat related to the predictions. So how does Fed take consumers' expectation into account?
Yeah, I mean, as I said, one of the critical things in monetary policy is inflation expectations. Yeah. We learned from the 70s and today that if inflation expectations become unanchored, like people don't believe you that you're going to bring inflation back to 2, well, then they think, well, it could be 3, it could be 4, it could be 5. And when that happens, then all kinds of economic behavior becomes unanchored and can lead to very bad outcomes. So a critical job for us was to communicate over and over and over the last 2 years is we will bring inflation down. That is our job. That is what we're going to do, and we're going to set policy accordingly. And we had to ensure that people believed that was credible and they would do that. Now, if you look at the data for the last 2 years, they believed us. Longer run expectations never came off at 2%. Usually by the consumers. Consumers have a range of expectations. They can be above, they can be below, but kind of the median never really got too far off. And certainly in financial markets, it never really got too far off. Near term, yeah, but not longer term expectations. So this is where we look at what consumers' perceptions are because we cannot afford to have inflation expectations become unanchored.
Okay, thank you.
All right.
I earned my lunch.
You did earn your lunch. Well, seeing no further questions, on behalf of the Department of Economics, I'd like to thank all of you for participating with us this morning, and I would like to personally thank Chris Waller for his support, for his friendship, for his insights as a policymaker, and for being with us here today. It's been a real treat. So let's all give Governor Waller one more round of applause.